Welcome to the Deep Dive. Today we're jumping straight into the numbers, the strategy, and the story behind Graham Corporation's latest earnings call.
That's right. Ticker GHM. We're covering their fiscal Q2 2026 results. And look, this one was a real head-scratcher.
It really was.
Our mission today is to kind of unpack that tension for you, because you had this massive, massive win on revenue.
Huge.
That was immediately met with some, let's say, serious questions on profitability.
Yeah.
And that's the core conflict we need to dig into.
Okay, let's do it. Let's start with that top line, because the numbers were, frankly, exceptional.
Yeah, they were. Net sales came in at $66 million.
$66 million, and that's a 23% increase over last year.
Exactly. It just blew past what Wall Street was expecting. The consensus was, what, 57, 58 million?
Something like that, yeah. So when you beat revenue by that much, you expect the stock to pop. You expect fireworks.
You do, but that's not what happened at all. The stock was basically flat. And there's a very simple reason why.
The bottom line.
The bottom line. All that revenue growth didn't translate. Adjusted EPS earnings per share was 31 cents.
Which was completely flat year over year.
Completely flat. You know, it beat some of the lower estimates out there, but it actually missed the higher Zacks consensus of 33 cents.
So there you have it, this classic conflict. Incredible volume, but zero profit growth.
And that explains the market reaction perfectly. You saw some selling in the pre-market, then it just closed flat. It's like the market sent a message, right?
Yeah, the message was, great, we see the demand, but show us the money. Where are the margins?
That's the crux of the entire quarter. Yeah. The margin conversion, or, the lack of it, it all comes down to gross margin pressure.
And it was a pretty significant drop.
Oh, yeah. Gross margin contracted by 220 basis points. For everyone listening, that's 2.2 percentage points. It fell all the way to 21.7%.
So for a company like this, a high-tech engineering firm with sales going through the roof, that kind of drop is the big red flag.
It's the only thing analysts wanted to talk about.
So what was management's explanation? I mean, is this a structural problem, or was it something more temporary?
They were very, very clear that this was mostly about timing. Temporary factors. They pointed to two main things.
Okay.
First, and this is the big one, they had a really unusual amount of low-margin material receipts that they had to book this quarter.
Okay, wait, unpack that. Low-margin material receipts. What does that actually mean for the business?
Right. So think about these huge multi-year defense contracts. The accounting rules say you have to recognize the cost of your raw materials, all the steel, all the components, when they hit your warehouse.
Long before you've actually done the high-value engineering work and can bill for the finished product.
Exactly. So your costs get booked in one quarter, but the high-margin revenue comes later. Management said that single timing issue accounted for about 180 basis points of the margin drop.
Wow. So if 180 of the 220 basis point drop is just an accounting artifact,
it starts to look a lot less scary.
Yeah.
A lot less structural.
Okay, so that's most of it. What was the other factor?
The other piece was just a tough comparison to last year. In Q2 of 25, they had a $400,000 benefit from a Blue Forge Alliance grant. That didn't repeat, obviously, so that accounted for the rest.
Got it. So between those two things, the whole margin story is pretty much explained.
It is. And it's important to remember, the revenue strength was everywhere. Defense was up a crazy 32%. But even energy and process was up 11%. It was a strong quarter across the board.
And through all this, their balance sheet looks great, which is, really important for funding what they want to do next.
Absolutely fantastic. They ended with over $20 million in cash, zero debt, and almost $45 million available on their revolver. They are funding their own expansion, and aggressively, too.
Yeah, how much did they spend on CapEx?
$4.1 million just in this quarter. That financial strength lets them ignore the quarterly noise and just focus on the big picture.
And the big picture is all about the order book. Let's pivot to that, because the visibility they have is it's why the market is still giving them the benefit of the doubt.
It's stunning. I mean, they booked $83.2 million in new orders.
That's a book-to-bill of 1.3. Very healthy.
Very healthy. But the headline, the real story, is the total backlog. It surged to a record, $500.1 million.
$500 million. For a company this size, that is an enormous number. How solid is that backlog?
Rock solid. Management made a point to say that about 85% of it is tied to the high visibility, long cycle U.S. defense market.
We saw proof of that, right, with the torpedo program?
Yep. A $25.5 million follow-on order for the Mk-48 torpedo program. That's their bread and butter.
But it's not just defense. They're making moves in other high-tech areas, too.
They are. Their Barber-Nichols subsidiary, which is really their, specialized tech arm, landed $22 million in new commercial space orders.
So they're diversifying within that high-tech space. That's smart.
It is. Now, of course, all that defense work brings that lumpiness we just talked about.
Right, the timing issues. How do they tell people to think about that volatility?
They're pretty upfront about it. They say, look, our long-term goal for book-to-bill is 1.1. But any given quarter can be all over the place. They've seen it as low as 0.5 and as high as 2.8. It's just the nature of these huge contracts.
But they gave a key metric for what to expect.
They did. They said to expect 35 to 40% of that $500 million backlog to convert into actual revenue over the next 12 months. And that gives you real confidence in their guidance.
Let's talk about that guidance, because this was the other surprising part of the call. Despite that massive Q2 revenue beat, they reaffirmed everything. They didn't raise it.
Right. Full year sales guide is still $225 to $235 million. And crucially, they're sticking to that higher gross margin target of 24.5% to 25.5%.
So why hold the line? Why not raise the revenue guidance after such a huge beat?
That was basically the first question in the Q&A. And management's answer was simple. Timing.
They just pulled sales forward.
They pulled sales forward into Q2. They said they're just being prudent, reminding everyone that Q3 is always their weakest quarter because of the holidays. So, it's a disciplined move to manage expectations.
It's good to see them managing external stuff too, like the tariff situation.
Yeah, that was a nice little positive update. They narrowed the expected headwind for the year, dropped the top end of the range by $1 million. It shows they're getting more efficient.
Agreed. But the real story now is how they plan to grow the margin from here. It's all about investment.
Yep. Two big buckets. First is technology acquisition. They closed the deal for Xdot Bearing Technologies in October.
Now, Xdot is a tiny company, right? Like $1 million in sales. What's the strategic value?
It's not about sales volume. It's about the tech. They have patented foil bearing IP.
Which is critical for what?
High-speed rotating machinery. Think specialized turbines, compressors. Exactly what their Barber-Nichols subsidiary does for space and defense clients. It's a technology buy to give them a competitive moat and pricing power. They even said it should be slightly accretive this year.
Okay, so that's the tech buy. The second area of investment is just raw cash into automation.
A lot of it.
Yeah.
Guiding for 15 to 18 million in CapEx for the full year. And we're talking about major projects here. Automated welding systems, a new cryogenic test facility in Florida. This is serious stuff.
These aren't just little tweaks. They're trying to structurally change their cost base.
Yeah.
And they were pretty bold about the expected return.
They were. They underlined that all of these big investments are targeting a return on invested capital, an ROIC of over 20%.
20%.
That's the whole thesis. This is how they get to their long-term goal, which is low to mid-teens adjusted EBITDA margins by fiscal 2027. They're betting that this spending spree will solve the margin problem for good.
So if you're an investor, you're looking at a company that's actively trying to transform itself from, a general industrial company to more of a high-tech, defense-focused platform.
Exactly. And the whole challenge is execution. Can they take this incredible backlog, integrate this new tech, and make these 20% plus ROIC projects actually deliver higher margins?
It's a total show-me story right now.
Textbook. The market sees the potential, but that gross margin lag this quarter is the hurdle. They have to prove they can clear it.
The stock's technicals are strong, though. IBD rating of 96. It's been a great performer, so the market wants to believe.
It does. So we're watching for a few things. We want to see those margins stabilize in Q3.
Yeah.
We want to see a smooth integration of Xdot, and we want to see those big capital projects coming online and delivering that ROIC.
Okay. Let's switch gears. As always, what we're about to discuss is for informational purposes only. This is not financial advice.
This is where we game out an outrageous but maybe plausible trade idea that looks past the short-term noise.
And the setup here is just perfect for it. You've got this record backlog. 85% of it is super reliable defense work. That's your foundation.
But the stock price is being held down by this anxiety over the margins.
So the trade is a pure conviction bet. You're betting that management actually pulls it off, that these automation projects with the 20+% ROIC, that they actually work.
The thesis is simple. You go long the stock, you're betting that they hit their fiscal 27 EBITDA target, which will justify a much higher multiple on the stock.
Okay, but now for the twist, the part that makes it a little outrageous.
Right. So to structure the trade, as you're buying the stock, you could simultaneously sell long-dated, deep, out-of-the-money put options. Maybe go out to 2027.
So you're selling insurance against the company failing to fix its margins.
Precisely. You collect that premium, that cash, right up front. And that income helps lower the cost of your long stock position. You're using the market's current anxiety to your advantage.
So if you're right and the stock goes up, you keep the premium and you make money on the shares.
And if you're wrong and the margin problem gets worse and the stock tanks, well, your put options get exercised. But you're forced to buy more shares at a much, much lower price, cushioned by the premium you already collected.
It's a way to play the long-term transformation story while getting paid for the short-term uncertainty.
So to wrap it all up, GHM, fantastic quarter for sales and orders. They've cemented this identity as a high-visibility, defense-focused company. The test now is converting all that good stuff into profit.
Yeah, that $500 million backlog and those 20% ROIC investments have to deliver on the bottom line.
They do.
Okay, so to leave you with one final provocative thought. Management keeps saying their goal is to maintain a 50-50 mix between commercial and defense business.
Right.
So here's the question. Does pushing to keep that commercial business alive and well help them innovate and bring new tech into their bigger defense contracts? Or does the gravity of the defense business eventually become a risk if, budgets suddenly shift a few years from now?
It's a real balancing act, and they have to get it exactly right over the next couple of years to deliver on what they've promised.
Thank you for joining us for this deep dive into the Graham Corporation earnings call. We'll catch you next time.